Imagine someone offers to sell you a money machine.
It spits out $10 a year, forever.
How much would you pay for it? Most people guess. The smartest investors in the world don't guess.
They use one formula.
And by the end of this video, so will you. Here's the truth nobody tells beginners. A stock isn't a ticker symbol.
It's a claim on a stream of future cash.
That's it. And there's exactly one honest way to figure out what that stream is worth today.
It's called discounted cash flow, DCF for short. Warren Buffett has said the value of any business is the cash it'll produce between now and Judgment Day, discounted back to the present.
That sounds intimidating. It isn't. I'm going to build the whole thing with you, one number at a time.
And the third step is where 90% of investors get the answer completely wrong.
Start with the idea everything else rests on. $1 in your hand right now is worth more than $1 next year. Why? Because today's dollar can be invested. It can earn.
So a promise of money in the future has to be shrunk, discounted, to reflect what it's worth right now.
Say you can earn 10% a year.
Then $100 1 year from now is only worth about $91 today. Push it out 5 years, and that same $100 is worth just $62 today.
The further away the cash, the less it's worth right now. That shrinking factor is the heart of DCF. Now we need the cash itself. Specifically, free cash flow, the money a business has left after paying for everything it needs to keep running and growing. Let's value a simple business.
It generates $10 per share in free cash flow today.
We'll assume it grows that cash by 8% a year for the next 5 years.
So year 1 is $10.80.
Year 2, $11.66.
By year 5, it's throwing off $14.69. These are our projections.
And here's the discipline part: be conservative.
Optimistic investors plug in 15% growth, fall in love with the result, and overpay. Graham called it the margin of safety for a reason. When in doubt, lowball the growth.
This is the step that separates real analysts from gamblers. We take each year's projected cash and shrink it back to today using our 10% discount rate.
Year 1's $10.80 becomes $9.82 today. Year 5's $14.69, only $9.12 today. Add up all 5 discounted years, and you get about $47 per share.
Simple. But here's the trap. The business doesn't stop after 5 years. It keeps producing cash.
That leftover value is called the terminal value, and it's usually the biggest piece of the whole calculation.
Get it wrong, and your entire valuation is garbage. Here's how we handle everything after year 5. We assume the cash keeps growing at a slow, safe rate, let's say 3%, roughly long-run economic growth.
The math gives us a terminal value of about $216 at the end of year 5.
But remember, that's a future number. We have to discount it back too. Shrunk to today, it's worth about $134.
Now we just add the pieces. $47 from the first 5 years, plus $134 of terminal value.
Intrinsic value, roughly $181 per share. So here's the payoff.
If this stock trades at $130, you're buying something worth $181 for a discount.
That gap, that's your margin of safety.
If it trades at $220, you walk away, no matter how exciting the story sounds.
Strip away the spreadsheets and DCF says one thing. A business is worth the cash it'll hand you over its lifetime, brought back to today's dollars. That's it. The formula doesn't tell you the future. It forces you to be honest about your assumptions. And when the market panics and offers you a great business for far less than your conservative estimate, that's not risk. That's opportunity. Price is what you pay. Value is what you get. So here's my question for you. What discount rate do you use when you value a company, and why? Drop it in the comments. I read every one.
This is educational content, not financial advice. Always run your own numbers before you invest.
If this finally made DCF click for you, hit subscribe. Tomorrow, we're tearing apart the one assumption inside every DCF that can quietly wreck your whole valuation. You won't want to miss it.